Fastenal just did something it hadn't done in years. It grew sales almost 15%, and the market sold it off anyway. Here's why the best industrial distributor in America got punished for a great quarter. Revenue climbed to $8.2 billion in 2025, and the second quarter of 2026 jumped to $2.39 billion. After a year and a half of low single-digit growth, daily sales reaccelerated from 12.4% in the first quarter to 14.7% in the second. This is a real inflection. Look at the second quarter scorecard. Net sales up 14.7% to $2.39 billion. Net income up 15.9% to $383 million. Earnings per share of 33 cents, up from 29. On the top line, this beat expectations. And yet the stock fell about 3% on the report. A revenue beat, an inline profit, and the shares dropped. That reaction is the whole story, because it's really a story about price. So why did the market flinch? 2 reasons. First, a lot of the growth is price, not volume. Pricing added about 2.9%, much of it passing through tariff-driven costs. Second, gross margin fell 75 basis points to 44.6%, with about 40 basis points of that from unfavorable price versus cost. The company is recovering higher costs a step behind. But step back 5 years and the margin picture looks very different. Gross margin has drifted down steadily, from 46.2% in 2021 to 45% last year and 44.6% this quarter. Operating margin, though, has barely moved, pinned near 20 to 21% the whole time. That's the model working as designed. Bigger customers carry lower margins but leverage fixed costs. The 75 basis point drop isn't a shock. It's a decade-long trade. Here's what defended the profit line. Fastenal grew sales almost 15% while adding total headcount of under 2%, helped by new AI tools that speed up quoting and onboarding. Operating expenses improved 80 basis points, fully offsetting the gross margin pressure and holding operating margin flat. And return on invested capital hit 31.4%, near a decade high. And the growth was broad and high quality. Heavy manufacturing grew 18%. Total manufacturing, almost 15%. Non-residential construction, helped by data center and electrical work, grew 17% for the second straight quarter. Contract customers, now more than 3/4 of sales, grew almost 18%. This is share taking inside the largest accounts, not a rising tide. Now the valuation and why the sell-off makes sense. At about $45, Fastenal trades near 39 times trailing earnings, richer than Grainger at 37 and MSC Industrial at 30. Treat it as a normal cash flow business and run the numbers. A bear case implies about $16 a share. A base case, about $24. Even a bull case with double-digit cash flow growth and an 8% discount rate only reaches about 37. Hold its own premium multiple and you get about 46. Today's price sits at the very top of that range. This is implied value under stated assumptions, not a price target. And the biggest risk is one the filing spells out. Fastenal says the tariff and import cost hit to net income was immaterial in the first half, but warns it may grow in coming quarters as cheaper, lower tariff inventory is used up and replaced with inventory that carries the new, higher tariffs. In other words, the harder part of the squeeze may still be ahead. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description. So here's the bottom line. Fastenal delivered an excellent quarter. Real share gains, best-in-class returns, margins defended by discipline, and still got sold because at 39 times earnings it was priced for perfection and merely delivered great. Watch 3 things next quarter. Whether price beats cost, whether gross margin holds the 44 to 45% line, and whether the momentum carries into a new CEO's first full quarter. The business is compounding. The only question is whether it can compound fast enough to earn the premium.